Have you ever noticed something frustrating in trading? When you expect price to come back to your level, it never does. Instead, price turns just before your level and takes off without you. You're left wondering, why does price always leave me behind? Today, we're going to explore one possible reason. Let's take a look at the dollar index on the daily time frame. Focus on these two candles. This bearish candle and the bullish candle that follows it. As many traders know, when a bullish candle closes above a bearish candle, that bearish candle often becomes a support level. In this example, the bearish candle did support price, as shown by the red arrow. But look closely. The bearish candle I marked in red never actually touched the blue line. There was a small gap. That's what we're focusing on today. If you placed your buy order exactly at the blue line, your trade would never have been triggered. Some traders would say this is a broker trick. And yes, sometimes brokers can manipulate spreads. But that's not the whole story. Sometimes there are legitimate reasons in the price structure itself. So let's dig deeper. Now look at this bullish candle marked by the yellow arrow. What is special about this level? It's not an obvious order block. Maybe it's related to a fair value gap. Maybe it's a volume imbalance. Different traders will have different interpretations. But here's another way to look at it. Let's switch to the 2-day time frame. On this time frame, those two daily candles actually form one bearish candle. Then we get a strong bullish candle that closes above its high. In other words, the 2-day structure already reclaimed the level. Because of that, price didn't need to return to the daily bearish candle. Simply tapping the yellow line was enough. We could stop the analysis here. But if you're someone who likes precision, that explanation might still feel incomplete. You might ask, why did price even overshoot the yellow line? There must be something else in the price action. And that's a very good question. Now let's look at the 12-hour time frame. Do you see the answer? I've marked it in red. There is a down candle on the 12-hour time frame, and price stopped exactly at that level. With that degree of precision, the reason behind the move becomes much clearer. In this analysis, we looked at 3 different time frames. Daily, 2-day, 12-hour. Each one revealed a different layer of the same move. Now you might ask, how can we know this in real time? The honest answer is, we usually can't. What we're doing here is studying hindsight examples to build pattern recognition. Over time, when similar situations appear, you begin to recognize them faster and with more confidence. And that's how experience in trading is built. Hope you found this insightful.